things could still go wrong, of course. I think it's hard, but not impossible, to come up with a list of reasons why the Fed wouldn't go in July.
Crypto prices fell sharply after the Fed announced it would keep interest rates unchanged after more than a year of rate hikes. Yesterday, however, the Fed also projected 2 more rate hikes this year.
Today, Binance addresses its emergency fund fluctuations following the charges against the crypto exchange. The SEC asks for more time to respond to Coinbase regarding crypto clarity.
Hello and welcome back to my channel. What's on the horizon for the crypto market in the U.S.? Are we going to see more trouble in the market? How will the Fed's decision impact the economy and market? In today's video, Chamath Palihapitiya has shared his insights on the current state of the economy and crypto market. To know more details, stay tuned till the end of the video. And if you want to stay up to date with the latest crypto insights, markets, and economy, make sure to hit that subscribe button and the bell icon. All right, are you ready? Let's dive right in.
Rates are going to be higher than you want, and they're going to be around for longer than you like. And now Powell is basically telling you the same thing. So we're almost at the end of, I think, the bottoming, though. And the reason there's not going to be a hard landing is you just saw China today basically say we're going to start to rip in trillions of dollars. They're going to stimulate the economy. You can't have a hard landing when China's printing trillions of dollars. Not possible. So I think that what Powell was forecasting is that if China starts to basically turn on the money printer and go through a huge spate of quantitative easing, it's going to just inflate everything because they're just such a critical artery to the world economy. And so you just have to get prepared for rates just being sticky and inflation being sticky. And I think that that's probably the most reasonable base case for the rest of the decade.
Rest of the decade, 7 more years.
Yeah. And so in that environment, the problem is that now you have the 7 or 8 most valuable tech stocks priced to perfection yet again. If you look at their enterprise value over their net income, these things are trading at astronomical yields that are less than half of the 2-year note and now approaching sometimes less than half of the 10-year note, government bonds. That makes no sense. And if you subtract out those 7 or 8 biggest companies in the S&P 500, the S&P has not been a great asset. So I think the equal weighted index, Brad, you probably know the exact number. The equal weighted index is just shit. So what does all this mean? I think it means that people are psychologically exhausted with having lost money. They are psychologically wanting to will the market up. They want to psychologically believe whatever will allow them to influence rates getting cut. But I think the most reasonable bear case is rates aren't getting cut, and whatever hope you had of rates getting cut just went out the window today because there is no world in which you cut rates when China's going to print $1 trillion.
The Federal Reserve takes a breather on rate rises, but signals even more tightening ahead. Powell has made it clear interest rates are going to stay high for a long time. Chamath highlights that China has announced a massive stimulus plan to boost their economy. China is a major player in the global economy. If they flood the market with money, they will cause inflation to rise everywhere. This is bad news for tech stocks. People are craving a narrative that whispers sweet promises of rate cuts. But the truth is, rates will not go down, especially with China's stimulus plan. And stocks will not go up, especially with high rates and inflation. That's the harsh truth that tech investors need to face.
And I think there's 2 ways to look at this. One is the conspiracy theorist way, which you see a lot of on Twitter, which is this idea that crypto is making all of these inroads as a replacement mechanism for fiat currency. And so governments are really now invested in trying to shut it down. I think that's largely untrue. And then there's the more simple, basic reality, which is that there was one part of the SEC that frankly didn't do the job that they were supposed to by either allowing a few of these crypto companies or crypto businesses to go public, either as standalone businesses or as part of other businesses, so Coinbase, Robinhood, etc. And then there's this part of the enforcement action after this FTX fiasco, which is a lot of CYA covering your ass by the SEC, especially because it looked like they had some cozy relationships with them. And so they're coming down hard and they're going to go and systematically dismantle the largest actors, and they're going to go through the value chain. So I think the obvious place that they're looking now are the exchanges. They'll look at the custodial services. They will not approve any ETFs. And then eventually, I do think it trickles into all of the staking services. And eventually, I think it'll touch the venture community and all of those firms and funds that had a huge, robust business in staking these crypto projects in order to get coins, like founding coins and then being able to sell them.
You see, cryptocurrencies are gaining momentum as a replacement for traditional fiat currency. According to this viewpoint, governments are scrambling to suppress this digital revolution. It's frustrating to see regulatory obstacles hindering innovation in this rapidly evolving space. Chamath believes that a more reasonable explanation is that the SEC messed up big time. They failed to provide clear guidance and oversight for some crypto companies that wanted to go public. So, what does all of this mean for the future of cryptocurrencies? Well, it's a complex landscape, with government regulations vying for control while innovation pushes the boundaries. According to him, staking services, venture capital firms, and funds involved in staking projects will likely face the heat as well. While some voices call for suppression, Chamath believes it's crucial to find a balance that fosters growth and protects investors.
I think Brian Armstrong is a really, really, really good entrepreneur. And I'm a really big fan of his. That said, I just don't think that there's a lot of political support to visit this issue right now. And so, unfortunately, I'm pretty skeptical that you're going to see any form of legislation pass. I unfortunately think that the SEC has, by and large, put the entire sector into mate. And so I think that what Jason said is largely right, which is that it's going to force these companies to preserve enterprise value, to leave the United States and to jurisdictionally operate from a different place and to basically IP block and IP gate US residents from using their products and services. I also think that they're going to have to pay large fines. And so the only thing that'll be left is to adjudicate all of the staking stuff that happened and whether that was right or wrong.
The SEC will continue to harass and hinder the crypto companies, especially ones that offer staking services. They will also slap them with hefty fines and lawsuits. They will try to stop them from creating and distributing new coins. This is a terrible situation for the U.S. crypto scene. It will stifle innovation and drive talent away. Chamath believes that companies will have no choice but to pack their bags, bid farewell to the United States, and seek greener pastures in different jurisdictions. It will force them to either leave the U.S. or block U.S. customers from using their platforms. So what's on the horizon for the crypto market in the U.S.? Are we going to see more trouble in the market? How will the Fed's decision impact the economy and market? Let me know your thoughts in the comments below. And don't forget to subscribe to my channel for more updates on crypto and economy. Also, be sure to give a big thumbs up to this video. Thanks for watching, and see you next time.